If you're choosing your lender based off of whoever has the lowest interest rate, you're doing it wrong. I'm Rebecca Richardson, aka the Mortgage Mentor, and I like showing people how to really understand mortgages. There's a lot that's going on. You are buying a house, which is exciting. You're dealing with a lot of money, and you're dealing with things that you haven't heard before. And it's understandable because it's money. You want to pay as little as possible. However, there is a lot more to choosing a lender and getting the best deal than just getting the lowest rate. I wanted to walk you through how to read an estimate and how to compare different estimates to understand what you're really going to pay. Now, once you're under contract, one of the first official documents that you will get is what's called a loan estimate. And this is what it looks like. The first page will walk you through some of the details, letting you know if your rate is locked or not, what the interest rate is, your loan amount, the sales price, your payment for the principal and interest, and including escrows, or basically a reserve account for your property taxes and your homeowner's insurance. It will also then show you the total for closing costs and the total due at closing, including those closing costs and your down payment. The second page then breaks out the different fees, and they are grouped into different sections based off of the fees that the lender can control, the ones that are associated with title or the closing attorney, and then the ones that are associated with your escrow account. Again, an escrow account is going to be a essentially savings account that's attached to your mortgage. Every month you will pay into it for your property taxes and insurance, and then when those bills are due, they're paid out of that account. So I'm going to walk you through each section and walk you through sometimes what we see in these estimates, so you can have the tools that you need in order to make a smart evaluation of what you're actually being offered and what you will likely bring to closing. Now, let's say you have two options. You're getting a conventional loan, the sales price is $400,000, and you're putting 5% down. Now, I do have to give the disclaimer, these are made up rates. This is not a commitment to lend and all the other things that you would want me to say, but just for the purpose of illustration, I want you to see the difference here. So one of the estimates is at 6.99 and the other one is at 6.625. Whenever you are being quoted a rate, you should also be quoted the APR, the annual percentage rate. The payment that you will pay is going to be based off of the interest rate. So in this example, say 6.99. What an APR is, though, is it is an evaluation of essentially the rate that you're getting, the fees that you're paying, and then we're stretching those fees out as if it was over the life of the loan. And then that's how you get the APR. So it is a good idea to look at the APR, particularly from the standpoint of being able to say, what is my money costing me? Because when you're looking at the APR, then you can see which overall the cost is lower. However, you want to know that what you're spending your money on is still worth it. So what do I mean by that? I'll explain in a minute. But for the first thing, again, we have the options 1 and 2, one with a 6.99 rate, one with 6.625. So we'll see the difference right off the bat in the principal and interest. Then one of the games that loan officers will play is they know that if they can show you a lower payment and hopefully a lower cash to close, then you're going to pick them, because who wouldn't want the cheaper option? But what is important is to make sure that the quotes and the numbers that are being used are accurate. So in option 1, let's say that the taxes are showing as $350 and insurance of around $150. That is an accurate quote for this property. However, some loan officers, because the taxes are what they are and the insurance is what it is, regardless of the lender that you choose, quote whatever. Maybe sometimes it's to kind of manipulate the numbers a little bit. Sometimes it's more because they don't know and they don't care. But let's say in this case that the taxes are shown as $200 and the insurance is shown at $75. So the taxes aren't only $200, and nobody's going to be able to find insurance for $75 a month for a $400,000 home. But that makes that payment even lower, because when we're looking at it, it's like, oh my gosh, I'm saving $300 a month. That's a lot of money. Who wouldn't want that? One of the very first things that you're going to want to pay attention to is going to be the points, discount points, origination. Essentially, it's everything that on your loan estimate, that official document that you will get once you're under contract, is called Box A. And Box A is primarily really the only fees that a lender is going to control for the most part. So when we're looking at that, again, let's look at our example here. So option 1, option 2. We've got an origination on option 1, and we've got a little bit of discount point. Discount points are extra fees that you pay at closing to get a below market rate. And then we've got some other miscellaneous fees with the flood certification, make sure the home isn't in a flood zone, and credit report fee, and also the appraisal. So right from the get-go, you can see option 1 is cheaper than option 2. So higher rate, but lower fees. Option 2 is lower rate, higher fees. You always want to pay attention to what you are paying for, because plenty of times some loan officers will tell buyers, we don't charge any origination, which sounds great. However, if they're charging a ton in discount points, not having an origination fee really doesn't help you. The next section that you want to pay attention to are going to be the title fees. And these are going to be the fees that are associated with closing attorney or title company. And they're the ones that handle the actual transaction of selling and buying the home. One of the things that's important is that a lender does not control any of these fees unless they're requiring or unless they are associated with a title company and you're not choosing the title company. The lender can really put whatever they want on here. For loan officers who want to quote accurately, they will be upfront and honest, because I don't know about you, but I don't like surprises when it comes to my money, and I would rather know upfront how much I'm going to pay. I don't like surprises last minute, and most people don't, and I bet you don't either. So in this case, when we're looking at the section C with title fees, we're seeing around $1,000 for attorney, and then we've got doc prep and all of these kind of things come down to what the difference is. Again, in this example, it's like, I'm paying more in points, but overall, now this looks like I'm saving around $450. But are you? Because we're going to get to that in a minute. The next section is going to be around prepaids and the initial escrow. So prepaids are essentially the things that you are paying up front at closing. And then the escrow is going to be a cushion of 3 months, usually of 3 months worth of taxes and insurance to have in your escrow account. So when those annual bills are paid out, when your tax bill is paid, when your insurance bill is paid, that there's enough in there. And in case those bills go up, because they usually do, that there's a little bit of a buffer in there. Now, in this case, let's say you're closing on the 15th of the month. When you're doing that, you always skip a month and then payments will begin. You do have to account for the 15 days. Let's say you close on the 15th of the month. You need to account for the remaining 15 days that you are in that home and that the loan is active. And that interest is collected at closing. So your first payment pays the interest for the month prior and so on and so forth. At closing, we have to account for those 15 days. So in this case, let's say option 1 is being quoted and we know that they're going to be 15 days. This 1,092 is the right number. But if you get a quote from a loan officer who is unscrupulous or frankly doesn't care, then they might only put 1 day's worth of prepaid interest. And right from the beginning, we know that that number isn't right. It does make the bottom line look better, but it does not actually accurately reflect what you're going to pay. So also, if taxes and insurance are underquoted, that gets amplified here. So not only is your payment being underquoted, but your cash to close is being underquoted because there's not going to be the correct amount of what you're going to pay for the insurance and also for the taxes. So how all of that totals up for these examples is we'll see on the left with option 1, around $31,000 being brought to closing, and option 2, $32,700. So you think, well, I mean, $1,500, that's more money, but think about, I'm saving like $300 a month. I mean, I'll make that up in less than a year. However, again, this is where it's important to make sure that we are actually being quoted correct numbers, because the reality is that if we had the correct numbers up front, yes, you're getting a lower rate, but you're only saving about $95 a month. And when you're talking about that big difference in discount points, you would basically have to keep this mortgage, meaning not refinancing, not selling. You would have to keep this mortgage for almost 5 years, recoup the amount of those higher costs. So once we factor in that higher cost for the lower rate and accurately reflect the title fees, the taxes, the insurance, the prepaid interest, all the things that we just talked about, then you'll see you're actually paying you're paying more than $4,500 more at closing to save $95. So once we total that up with the correct numbers, with the correct taxes, with the correct insurance, with the correct prepaid interest, and all of those things, you can see that you're paying more than $4,500 closing to save $95 a month. Again, shopping the lowest rate doesn't necessarily make it the best deal, because I bet that you can do a lot more with $4,500 than get a slightly lower rate. Biggest thing that I want to just caution you of is make sure that you are working with somebody with integrity, with character, great reviews, that's been personally recommended. You've seen how they work, all of those kind of things, because it is really important when we're talking about making sure that you are working with someone who is taking care of you, who is looking out for you, because when you're buying a home, again, it's a lot of, I don't know what I don't know. And you have to make sure that you're being paired up with a realtor and a lender who is going to look out for you and understands that there are things that you don't know, but they do. They need to make sure that they are protecting you throughout the process. I'll put a link to this quote comparison in the description. So you can use it, you can download it, use it to compare any kind of options to make sure that you're going line by line and make sure that you're getting the deal that you are. Before we get into it, please make sure that you subscribe so you can get all the information that you need about mortgages. And also please make sure that you like and comment. It helps me out. I do appreciate it.